Many times, we think that large financial institutions are designed only to benefit the wealthy, business owners, or politicians. We feel like these systems work for everyone, except us. But let me tell you something, it is possible to use the financial system to your advantage, even if you don't have a lot of money. The key is understanding how banks really work. And today, I'm going to explain it in a clear way, with examples that apply directly to life in the United States. What is a bank and how does it make money? A bank doesn't sell physical products or digital services like other companies. Its raw material is money. And its main goal is to collect as much of it as possible from customers, through savings accounts, checking accounts, and other financial products. Once a bank has your money, its job is to move it, lend it, invest it, and make it grow. For example, it takes money from your savings and uses it to offer personal loans, mortgages, credit cards, or to invest in the financial markets. The bank pays you very little interest, if anything, for your money, but charges others much more when lending it out. That's why their ideal customer is someone who doesn't know how to grow their money and just leaves it sitting there. But you can change that. You can learn to play the same game and win. 1. Don't let your money sit in a traditional savings account. What is a traditional savings account? It's a bank account where you can store money and withdraw it whenever you need. Sounds good, right? But here's the problem, many of these accounts offer super low interest rates, sometimes as low as 0.01% per year. That means if you leave $1,000 in the bank for a whole year, you'd earn just 10 cents. What does the bank do with your money? While your money sits there, the bank lends it out to others at rates that range from 7% to 25% or more. They make money using your money, and you barely see any of it. Types of accounts. Demand deposit accounts, like basic savings or checking accounts. You can withdraw anytime, but earn almost no interest. Time deposits or certificates of deposit. You agree to leave the money for a certain time period, in exchange for higher returns. If you take it out early, you get penalized. If you have money you won't need soon, open a high-yield online savings account, offering rates around 4% to 5% annually. 2. Never pay interest on your credit card. What is a credit card? It's a tool that lets you borrow money from the bank to buy now and pay later. But if you don't pay on time, you get hit with very high interest, often 25% or more per year. The most common mistake. People pay just the minimum balance, thinking they're safe. But that minimum only covers a small part of your debt, while the rest racks up interest. You buy a $1,000 laptop. You only pay the minimum each month. After a couple years, you end up paying over $1,600 for something that cost $1,000. It's like buying another laptop, just an interest. Pro tips. Look for cards with no annual fee or useful rewards. Pay your full balance each month to avoid interest. Set payment alerts so you never miss a due date. Use rewards cards, cashback, points, miles, only if you can pay on time. 3. Don't accept a loan without reading the fine print. What's the fine print? It's all the small details in a contract most people skip, where all the real costs are, interest rates, origination fees, penalties, etc. What is APR? APR, annual percentage rate, includes interest in all loan costs. It's the best way to see how much a loan truly costs. Example. You're offered a $10,000 loan with $220 monthly payments. Sounds manageable, but the APR is 24%. In the end, you'll pay over $15,000, that's $5,000 just in interest. Before accepting a loan, ask. What is the APR? Can I make early payments with no penalty? What's the total amount I'll repay? Are there any upfront fees? Make banks compete for your business, not the other way around. 4. Don't invest in products you don't understand. What kind of products do banks offer? Certificates of deposit, CDs. This is like a deal. You let the bank hold your money for a fixed period, 6 months, 1 year, 5 years, and they pay you a fixed interest rate. How it works? You pick the amount and the time frame. The bank offers a fixed interest rate. You can't touch the money early, or you'll be penalized. Example. You invest $5,000 in a CD for 2 years at 4%. At the end, you earn $400 in interest. If you withdraw early, you lose part of that interest. Good for people who don't need the money soon and want a safe return. Cash value life insurance. It's a mix between life insurance and a savings or investment account. You pay monthly or yearly, part goes to insurance, part is saved or invested. How it works? You get life insurance coverage. At the same time, you build savings. Some policies promise fixed returns, others invest in the market. Example. You pay $100 per month. $60 goes to the insurance. $40 goes to a savings account. After several years, you could have $3,000 plus saved. Downsides. High fees. Complex structure. Not always the best way to invest. Best for people who want life insurance plus a forced savings plan and are okay with the costs. Managed investment accounts. You give the bank or advisor your money, and they invest it for you. How it works? You choose your risk level, conservative, moderate, aggressive. The bank invests in funds, stocks, bonds, etc. You don't choose the investments, they do. Example. You invest $20,000. The bank earns you 6% annually. They charge a 1% fee or more for managing it. Downsides. High fees. No control over investment decisions. Best for people who don't want to manage their investments and prefer expert help, even at a cost. In summary, many of these products have hidden fees, low returns, or confusing conditions. Real-life example. A bank offers you a 2% CD for 5 years. But inflation is currently 3.5%. You're actually losing money. This is called negative real return. Important distinctions. Nominal return, what they say you'll earn. Real return, what you actually earn after inflation. If inflation is 6% and you earn 5%, you're losing purchasing power. Pro tips. Learn the basics before investing. Look for products with O returns above inflation. O low management fees. O flexibility and transparency. Conclusion. Banks are businesses. Their goal isn't to make you rich, it's to make money off of you. But if you understand how they work, you can use their tools to your advantage. Remember, don't leave your money in accounts that don't grow. Use credit cards smartly. Always read loan terms. Never invest blindly. If you like this video, drop a comment and tell me which tip helped you most. And if you want more advice like this, subscribe and turn on notifications. See you in the next video.